Hello, friends. In this video, we're going to talk about the macroeconomic outlook. We can think of macroeconomic as factors that are global in nature, but it affects us. It need not be global, sometimes they're local, but at the moment, the more important factors that are affecting the macroeconomic outlook of any country is actually a global phenomena. So, Federal Reserve and its propensity to raise interest rates, the war in Ukraine with Russia, the situation of COVID in China. As you can see, none of them are actually Indian headlines. So, why should we think about it? And how does it impact us to begin with? Federal Reserve is a body which is actually not owned by the government of India or controlled by the government of India, as is the case of central bank in India. You would be surprised to know that Federal Reserve in US is basically a self-regulating body like you know Association of Mutual Funds or Association of Brokers in India. They don't have any regulatory authority as an independent regulator, but they are the ones who are setting the prices in terms of interest rates. So, as a cohort, they decide and they are mandated by the government to decide whether there is full employment in the economy, which means they have to protect employment and they have to protect price stability. And usually these are at odds with each other, so they sacrifice one versus the other. What is happening now is, if you look at the actions of US Federal Reserve over the last few quarters, they have continuously raised interest rates and have guided forward to raise interest rates. US is a different economy. There, if you default on loans, you can just walk away, and the bank has to foreclose your asset. Versus somewhere in India, for example, if you do not pay your home loan, the bank really goes after you to make sure you pay the home loan by selling your property and then recovering the money. US is different. So what happens in US is that as they raise interest rates, demand for property, demand for consumer discretionary goods like be it electronics, holidays, restaurants, all get impacted directly, and demand falls off the cliff. And as demand falls off the cliff, there is less demand, which means you have to lower your prices to bring back those customers. Hence, the inflation goes down. US has peaked in its inflation. The last few prints have been in a downward trajectory. And the flip side of that coin is when you try to do something like this, you create unemployment. Large companies are laying off people. As people get laid off and the news goes around, people get more cautious with their spending. They spend less, which further brings down prices. So that's point number one. As prices cool, US Reserve can continue to keep the prices stable by keeping interest rates at the place they are, or even cut them to bring back demand. And this directly impacts all emerging markets, including India, because we import oil, which is priced in dollar, and dollar gets priced given the interest rate prevailing in that particular economy. So, if you look at what is happening in BRICS country very recently, the South African foreign minister said, as BRICS, or Brazil, India, China, Russia, South Africa, why can't we trade with each other in our local currencies, keeping dollar aside? And that's a big threat for dollar because these are large consumption baskets. So obviously there'll be some sort of way of figuring out how this is going to work. The war in Russia directly impacts one of the greatest food baskets of Europe, which is import and export of wheat, where wheat is one of the staple in Europe in form of bread versus rice, which is staple in Asian countries. And the situation in China, where there's uncertainty about how this lockdown or not lockdown, large number of deaths reported, yet the state media not kind of siding with those stories. So there is a lot of uncertainty, and people are seriously looking at India as a second option where they can have like a backup. So, like, let's say if China continues to do well, that's your main electric supply, and you have a backup generator, which could be India. And sometimes, people pay a lot to be, having a backup, right? So the fear of unknown or, predicting downside, people are ready to pay a lot, and therefore India can benefit from it. Overall, all these factors could mean that India is in a pretty good place to benefit from such factors. Lowered interest rate means India can import oil, which is priced in dollar, at a lower exchange rate, which means Indian rupee strengthens further, which hurts exporters but cools down local inflation. Russia-Ukraine war means India can step up its distribution in food supply to rest of the world, can supply, IT services. Baltics regions, they are very good in providing IT services. Ukraine, for example, has a lot of professionals who are very good in technology. And with this uncertainty, although all that Polish, Ukrainian, Hungarian IT services business can, move back to India, or can get replaced as a backup in India. Or sometimes these professionals are actually asked to come and work out of India. For example, Indian IT services companies which had offices in Russia, when Russia invaded, they actually asked some foreigners in Russia to come and work out of Indian bases because they had to close down those offices. And similarly, in the COVID situation, in face of any uncertainty, any business leader is always going to keep a backup plan, and India looks pretty good there. So with these macro factors, what we see is that niche players, in especially in the small cap, where they're dominating certain categories, or even mid to large size IT service providers, pharma, for example, they all can do well among these among these macroeconomic factors, and India is very well positioned to take advantage of these kind of problems that are emanating in the rest of the world. Thanks for watching. My name is Abhishek Banerjee, founder at Lotusdew. See you again soon. Bye.